How did one of the largest banks in the United States suffer one of the quickest downfalls in the history of mankind? I am talking about a Goliath bank who had $212 billion in assets and 10% of the U.S. economy under management becoming undone in just 36 hours. Well, just like most things, it had to all start somewhere, and we are going to explore just that. Together, let's take a look at one of the most infamous banks in the United States. To truly grasp the essence of Silicon Valley Bank, we must take a look into its origins. It was founded in 1983 in Santa Clara, California by a group of entrepreneurs and investors. The bank was created to support the technology and innovation industries in the Silicon Valley region by providing financing, banking, and investment services to startups and established companies. In its early days, SVB focused on serving the needs of the semiconductor industry, which was rapidly growing in the region. The bank provided financing and banking services to companies such as Intel, Cypress Semiconductor, and National Semiconductor, hence gaining a reputation as a reliable and trustworthy institution, which eventually became a host for some of the largest companies like Roblox and Rocket Lab. While expanding into many countries such as Germany, Canada, China, and the UK, making it a worldwide success. SVB also experienced some of the highest of highs. In just 2 years, it amassed a crazy amount of $189 billion in deposits due to COVID, which only helped its popularity, making it only the second most profitable. While China stands at number 1, as it gained the most popularity over the entire duration of COVID. So where did it all go wrong? Despite these financial troubles, many people were shocked when Silicon Valley Bank finally collapsed in early 2023. Recently, the bank began to experience financial troubles. The primary reason for this was SVB saw an opportunity with all that cash coming in, that it decided to make one of the most understandable decisions. But little did they know that decision would be their last. SVB stockpiled about $100 billion in bonds, causing its portfolio to skyrocket. But what they didn't anticipate was a raise in interest rates. To give you guys a little bit understanding as to why that was very bad news for SVB, as interest rates go up, bonds value go down, and for the banks who happen to buy billions of them, well, to say the least, they were in trouble. Thanks to the new rates of interest, SVB bonds were worth $17 billion less than what they bought it for. Normally, that would be the worst-case scenario for any other company, but not for SVB. That was only the beginning, which begs the question, why is all of this happening to them other than it being self-inflicted? I believe they also managed to offend a higher power, and am assuming they didn't take it lightly. The collapse was also precipitated by a number of factors, including a sharp decline in the value of tech stocks and a sudden increase in the number of loan defaults. Bad investment also played a minor role due to the fact that many of its loans were made to startups that were not profitable and had little hope of becoming profitable in the near future. Famous faces like Kevin O'Leary blamed SVB's collapse due to quote-unquote.
So it doesn't matter how bad you are as a bank manager, and a good example is what happened at Silicon Valley Bank. That was a combination of a negligent board of directors and idiot management. That's a very powerful cocktail when put together.
Silicon Valley Bank's demise was a headline worldwide. SVB's kryptonite interest rates decided to land another fatal blow to them because of interest rates new high, new deposit rates reduced, and caused SVB another $30 billion from March to December. This scared a lot of venture capitalists who in turn called most of the startups and informed them to withdraw their money from SVB as soon as possible.
Startup CEOs began receiving urgent calls from panicked venture capital investors.
He was out of breath, like he had just run a marathon, and he said, take your money out of SVB, go into your account, take your money out as soon as possible.
What started as a trickle of withdrawals quickly turned into a tidal wave as word spread across the valley,
triggering one of the largest bank runs in U.S. history. The situation fell into complete chaos, which forced the U.S. government to step in and seize SVB before any more damage could occur. As a result of these factors, and an insane sequence of bad luck, Silicon Valley Bank was no longer able to meet its financial obligations, and it was forced to file for bankruptcy. This was a significant blow to the tech industry, as many startups and tech companies relied on the bank for funding and financial services. The collapse of Silicon Valley Bank had a significant impact on the tech industry. Many startups were suddenly left without access to funding, which made it difficult for them to continue their operations. In addition, the investors lost money as a result of the bank's collapse, which caused a great deal of uncertainty and instability in the tech industry. Fellow bank Silvergate also had to close because it unfortunately banked with SVB. Keep in mind this all happened within 36 hours. The only other time this happened was in the 2008 financial crises. After the Federal Deposit Insurance Corporation put out a statement saying that everyone would have their insured deposits within 3 days, which was only $250,000. Only issue with that was that the bank had more than $151 billion of uninsured deposits at the end of 2022, placing the people's money in jeopardy. Companies like Earth Optics suffered great losses. This caused mass panic and mistrust within the people. I mean, I get it. You chew on electric wire once you learn not to do it again. The collapse of Silicon Valley Bank serves as a reminder of the risks involved in investing in startups and other high-risk ventures. While the collapse was undoubtedly a painful experience for those involved, it also presents an opportunity for the industry to reflect on its practices and to work towards creating a more stable and sustainable financial environment for tech startups and investors alike.